Okay, we'll get started. So, welcome to the last Sunday pre-market meeting for 2025. So we won't be hosting one next week because this is my last week of trading. After that, I'm done, and I take 1 to 2 weeks off, maybe 3 weeks, depending on market liquidity and volatility and things. So I'm not going to be looking for many trades this week. Obviously, if I'm going to be off, I'm not overly interested in trying to manage positions at the Christmas dinner table. But there are some things we can pay attention to. And if you do continue to trade, then you might find this useful. Just for a note for people watching on YouTube, we've got something new coming in 2026. So we are going to be opening the Discord for free for certain categories. We've got free chat coming, and that's about it. So keep an eye out for that. So with the market, the Federal Reserve is a core driver this week. So on Wednesday, right here, we have the Federal Reserve interest rate decision. We are expecting to see, and when I say we, I'm talking market participants, CME FedWatch tool. We're expecting to see a 25 basis point cut. This will mark the third one. So I don't think there is anything to worry about in regards to the decision itself. So again, I think it's widely expected for it to be 25 basis points. That will come and that will go. However, what we always need to pay attention to is the statement and the press conference. And we've also got these projections to pay attention to as well. So the forward guidance, the statement and the press conference will give us forward guidance, and that will help us to start pricing in and placing positions based on what we think the Fed will do next. Now, I'm not expecting the Fed to really say or do much. I think it's going to be a relatively neutral to maybe slightly dovish tone. However, that is obviously very, very dependent on what Powell says. So that will be sort of the main watch until Wednesday. So if you are involved in the markets, just keep that in mind as expected, or I would expect the markets to remain pretty much range bound until we get that meeting. Things like gold, the S&P, NASDAQ, etc. So there is that. Any pushback on 2026 cuts. So if we get if we get Powell suggesting that we are going to get further cuts in 2026, obviously we could expect a weaker dollar as further rate cuts get priced in. Vice versa, if he starts suggesting that this was the final cut, 2026 is going to continue to hold, or that's what he expects, we could expect the dollar to see some strength on the back of that. Excuse me. So the RBA is expected to hold, which is reinforcing the Australia's pro-growth and yield-supportive profile. The Bank of Canada is likely to hold with softer domestic momentum, keeping the Canadian dollar more of a follower as opposed to a leader. The SNB, so Swiss National Bank, is expected to stand flat with Swiss losing its defensive premium in a pro-risk environment. So the Swiss, not really anything to do regarding the Swiss, but I will move on to that in a moment when we start looking at trades. Risk sentiment sits at neutral to mildly risk on. Again, we do have the Fed, which is swaying that risk profile slightly. I'm just checking notes here to make sure I'm not missing anything before we move into setups and ideas. So Japan is expected to hike rates. We'll move on to that shortly. That might not happen. It might happen either way. Again, we'll get onto the outcome of that shortly. The Australian employment either validates or challenges. Again, we do have some Aussie data to pay attention to this week. Anyway, let's move on to the charts and take a look at what's going on. So euro dollar is currently seeming like a really nice long position. Now, the thing with euro dollar is technically it's not looking fantastic. We are in a bit of a, actually I suppose we've just broken out, but we were in a downtrend. Obviously these really clean lower highs. It was essentially just sell on the pullbacks to 200 moving averages, and that's all you had to do. Obviously hindsight's great, but moving forwards, the central bank divergence is seeming relatively solid to support a position on euro dollar to the upside. So obviously, we've got the Fed that is expected to cut rates by 25 basis points, and we are expecting the Fed to continue to cut at least into early 2026, so first 1 to 2 quarters. The ECB is currently taking a neutral stance, so that gives us a relatively nice central bank divergence. Obviously, if we've got one central bank cutting and we've got the other one holding, we can look for positions to continue to the upside. So I'm looking to see if we can get a pullback into the 50% fib or the 61.8. Either way would be completely fine as long as it's within this zone. Ideally, that would also lead price to come and meet this 200 moving average before heading back to the upside. On a technical front as well, we do have some nice signs of an uptrend forming here. We've got the high we've got the low here. We've got a higher low relative to the previous one. We've got the high and now a higher high. So technically, again, technically uptrend is valid and fundamentally this trade is supported. We've also got the moving average cross indicating that trend change as well. We do also have euro dollar reading very bullish on the edge finder with a score of 10. Again, a really nice supportive factor for this trade. So it should be quite straightforward as long as we don't get any hiccups. Now, the caveat to taking a euro dollar long position or any position regarding the US dollar is, of course, the Fed. So what we don't want to do is enter a position on euro dollar. If we do see this pullback, the Fed comes out and says, actually, this is likely going to be the last. Obviously, I'm not expecting him to literally say this, but you get the idea. The last cut, for a significant period of time, or in 2026, we're not expecting to cut further, whatever it may be. That would obviously send euro dollar to the downside, potentially quite heavily as well. So I don't want to enter a position until we hear what Powell has to say regarding that. Next up is DAX. Now, I've kept the watch list relatively simple this week. I know sometimes we'll go a little bit further into economics and take a look away from the edge finder and look at our own ideas. However, again, because it's the last week of trading, and for me anyway, I'm not overly interested in doing a deep dive on everything today. So the DAX has got a bullish score of 7. Technically, it's a little bit ugly. Actually, we are stuck in a sideways range. However, I do think we could continue to the upside. Risk is looking completely fine for the equity and indices markets. We've failed to hold below this level of what was support, indicating that buyers are, again, completely in control. The uptrend remains intact. We did almost see a change here. However, it seems like we are likely to head further up. So with this market, I would like to see a break above these highs, a retest, and then that would be a potential entry to the long side. I don't really have a great deal of economics regarding the DAX specifically, so I do need to look into that further, but that is one for you to put on your watch list if you would like. The pound Aussie. Now, I'm really frustrated with this one. Some of you may remember, but we were looking to take the position like, position like this. So I was looking to see if we could get a gap fill. The gap's actually not showing here, but we did get the pullback that I was looking for. However, unfortunately missed it. Oh, my bad. I'm sorry. I've got the weekend brain. I drew that wrong. It was actually this high here that we were looking at right there. So unfortunately, the gap was here. We pulled back into the fib, but yeah, I didn't take the position. This move was way too quick for me to catch, unfortunately. So I would like to see another pullback up to sort of have a very small mean reversion towards this 200 moving average. Then I could execute long. Shorting here, in my opinion, isn't the most ideal situation. Although, yes, the pound is weak, we do have a hawkish RBA as well. The trade fundamentally is completely fine, but technically it wouldn't surprise me if we do see a little bit of upside off the support and then we break lower and continue lower from there. So regardless if we are able to get into this trade this week, I still think this would be a great position to take into 2026. It's just a case of waiting for that setup. I think we have a very, very weak outlook for the UK. I've spoken about that a lot over the past couple of weeks, so I won't go into that. But yeah, similar situation here on the pound Aussie. The only thing here is the setup isn't as clean, which is why there is no technical analysis here. I cannot really nail down where I would want to enter because there's two potential places. So either we get a smaller retracement back up towards this 200 and then we could look to short. That is completely valid. However, I'm a little bit concerned with this left side here. Generally speaking, when we have very large and aggressive or impulsive moves like this, we do see a correction. ICT people call that an FBG. I don't really care what it's called, but that's kind of the theory I'm going with here. So it wouldn't be a shock to me if we see price return back up to or within this candle and then continue to the downside from there. We can see a great example actually just here on the left. These aggressive impulsive moves generally do get corrected. It can take time, but it happens, and I don't want to get caught in that because it can happen very aggressively and very quickly. Anyway, moving on, we have the Aussie US dollar. Now, this is actually one of my most favorite setups, but we've missed the trade so far because there is absolutely no way into this market. It's one of those trends that's just been so aggressive. There's been no significant pullbacks to enter on. So I'm still waiting. But as I said, we do have the hawkish RBA. We've got a very bullish reading here on the edge finder of 9. We've got the Fed that's currently looking a little bit dovish. So the position is pretty much straightforward, but it's just, again, a case of where can we enter. So I'm looking either for a very small pullback to the previous high. If that's stopped out, fine, we can enter again here. I would be willing to take multiple attempts on this position just because I am very convinced we can continue higher. We do also have the moving average cross, again, just indicating that trend change. We're relatively deviated from this 200 moving average, indicating we could see a little bit of a mean reversion behavior at some point. But again, whether that will be this week, I don't know. And again, we do have the Fed, so just take caution. Euro pound. Now, this is an interesting one because a lot of people were caught out on euro pound trying to catch the fib, actually, which was obviously it depends where you draw it exactly, but it was something like this. People were buying on the fib, which at the time made a lot of sense. However, the thing with euro pound, it's not a great asset to trade in terms of price action. So if you just observe, if you go down to the H4, the H1, the daily, whatever it may be, you will notice that the behavior of the market is very difficult to gauge. It's very choppy, and it does mean revert very aggressively when that does happen. Now, I wasn't interested in being a buyer for those reasons. I thought it was quite elevated or very deviated from 200. I just wasn't overly interested in being a buyer, but I was watching it. Anyway, we're coming down to 87, which is a really nice round key level. And we already are aware, I can't remember when it was, to be perfectly honest, but we have had a couple of bank reports mention this exact level in their reports, saying that that's basically an area of interest and they could expect euro pound to pull back to that level before further upside. So I think, and this is a big I think, I don't know this for definite, but I am assuming there is some buy orders resting at 0.87 for us to capitalize on. So if we can come down to this level, I would be more than happy to enter in. It is a previous fib level. I mean, again, this is where the discretion comes in. We've kind of ignored this low, we've ignored this low, we've ignored this low, and we're using this one. So, take it as you will. It's not a super strong technical setup, but I think it's there. So if we can come down, close the gap between the 200, I will be happy to look for an entry. And again, we do have that aggressive impulse candle here that has now been corrected, which could also be a sign that we are ready to start heading a little bit further to the upside. We do have a couple of other things to pay attention to. So as I said at the start of this webinar, the Bank of Japan, or the yen, is an interesting one right now, because word on the street, and when I say word on the street, it's quite widely expected now for the Bank of Japan to hike rates in December. Whether they do that or not doesn't really mean too much. All it is going to do, in my opinion, at this time, is just slow down this rally a little bit. So we might get some sort of downside, not quite as aggressive as that. Again, it's already expected. So it might just be a little bit of a slow bleeder and then continue to the upside. It's not enough. So the current interest rate in Japan is 0.5. They're gonna, if they do hike, it would likely to be to 0.75, which would be a 25 basis point cut, or to 1%, which would be another 50 basis point hike. Sorry, not cut, hike is what I was trying to say. So it's not, the yen isn't going to lose its funding currency status in terms of, obviously, you borrow yen to buy other currencies, and that's the carry trade. We all should know that by now. So I'm not expecting that dynamic to necessarily change, but it might just be a little bit more of a slow move to the upside after they do hike, because obviously that will, what do we call it? Reduce the yield gap is what I was trying to say. But what I was going on to here is Aussie yen is actually quite a good buying opportunity. So we do have a bullish score on the edge finder. The fundamentals are there, absolutely. We've got the RBAs expected to hold with a stable, slightly hawkish tilt, keeping the AUD yield supportive. Ongoing global pro-risk rotation favors high beta carry positive FX over low yielders, which is obviously Aussie yen in a nutshell. The Bank of Japan is still moving slowly, pretty much. Even with normalization, the JPY remains a funding currency unless risk collapses. So obviously we get a large risk-off event, then, natural market dynamics, we are going to see the yen significantly strengthen off that. The main risk is a hawkish Bank of Japan shift or a sharp risk-off move around the Fed that can trigger a JPY short squeeze. Now, we will see. I mean, we are still waiting for the intervention by the Ministry of Finance. Whether that will come, I have no idea when or if it is going to happen. I kind of expected it to happen last week with the US Thanksgiving. We didn't get it. So it could happen over Christmas. Again, they like to do it during low liquidity periods, which again is Thanksgiving, Christmas, summer holidays, etc. Now, the other thing to note with Aussie yen is we have managed to clear pretty much all of the, in fact, yeah, fully clear all of these highs that we've had as resistance, and we've now broken into pretty much just clearing out this left side. So it wouldn't be a surprise to me if we can see the Aussie yen come back to around 108-ish. Now, again, actually getting into this market is going to be very, very tricky just because it's so aggressive. There is very few entry opportunities. So obviously here would have been great, here would have been great. So it's a case now of just waiting for the next dip to be a buyer. Now, again, there are certain risks like the intervention, like a very hawkish Bank of Japan. I wouldn't expect a hawkish Bank of Japan for certain things like the Abenomics dynamic over there. Feel free to Google. I'm not going to go into it here. So yeah, Aussie yen right now seems fantastic, but there are quite a lot of hurdles that we would have to watch out for with it. So pound Swiss is the last one we will cover because I'm actually in pound Swiss. So we were looking and I think we were talking about pound Swiss last week or the week before. So basically what I'm doing is I'm building up a DCA. I'm building up a cycle is what I call it. I've got an invalidation level at 109. So if we see pound Swiss reach 109, I'll cut the position and start looking to alter the approach. So the GBP is weighted down by weak macro momentum and future easing expectations, while the Swiss is losing defensive demand, but still sits in a very low rate environment. In a pro-risk regime, Swiss tends to underperform, but pound has the weaker growth story, so the cross can still grind lower. It's a good way to express the UK underperformance without taking direct US dollar or Federal Reserve risk. So, although, yes, the position is in drawdown, the trend, well, the move to the upside does look quite aggressive. On the larger scope here on the daily, actually nothing's changed. We're still really within this quite aggressive downtrend. We've had quite a few opportunities here where prices come up and continue lower. So that's all I'm expecting here is another push to the upside and then a continued lower. In terms of targets, I'm looking for the previous low right here, which is actually the all-time low at around 101. So I don't think there's really much else to discuss on here. I'm just going to check. Is it still on the Edge Finder? It is. So pound Swiss is also on the Edge Finder with -8. You can see there are some other pound assets like pound New Zealand, pound Aussie as well, which we could absolutely take advantage of. The only other thing to note with this market, if you are going to take pound Swiss short, just remember it's negative swap. Oh, sorry, actually it's positive swap. So if you're a seller, you will be paying to hold the market. And the SNB, so the Swiss National Bank rate is at 0%. The Bank of England is at 4%. So it's a very expensive position to hold. So ideally, you don't want to be sat in drawdown for too long. So if you are going to take the position, just be very careful about you are fully aware of the fees that you're going to have to incur to hold that trade. That is it. We are in Aussie, New Zealand. I'm not going to show it here because obviously it's going on YouTube. No free lunches around here, but you guys know that position is doing quite well. Overall, there isn't really anything else to bring up. We'll quickly just take a look at the dollar and then we'll call it a day. So let me just zoom out here. So the US dollar. What we've got is a trend change to the downside on the H4 right here, which is a bit of a red flag. We also have the Fed. We've seen buyers continue to fail. So we came up and retested this 100 level. Again, buyers completely failed to hold above. There is not really any, or there's not any major supportive macro catalyst to warrant a long position on the dollar right now. The daily looks okay. Actually, we did have a moving average cross indicating a bullish trend. However, it's now a case, in my opinion, of do we break lower and continue the path to the downside, breaking below the 200? Are we going to continue to the upside? I think what we're going to see is minor upside, and that would be driven by the idea that the Fed rate cut is already priced in. So what happens when something's priced in? And that's exactly what happens. Well, if you've been, let's say you've been selling all of this move saying, oh, the Fed's going to cut, the Fed's going to cut, the Fed's going to cut, then the decision comes and they do cut. What's your most likely decision going to be? Well, you're likely going to take profits. So this is basically what we call a buy the rumors, sell the news event. However, we've got to think a little bit deeper. Again, we are going to get that statement and the press conference, which is our forward guidance. From there, I would expect a little bit of a dovish tone. Could not happen. Again, don't take this word for word because I don't know what Powell is going to say. No one does. But I would expect it to be a dovish tone, which would then continue the dollar lower. So obviously this is on the H4 time frame, so don't take that price movement literally, but what I'm saying is maybe some short-term upside or very, very quick upside off the decision itself. Then we get the further downside as we hear more from Powell. It could be the opposite. But again, I'm just giving you my best idea right now. So guys, that concludes the webinar. Again, this is the last one for 2025. I see there's some messages here. Let me just take a quick look. So do you think the majority of trades like gold are already priced in? How do you mean, David? Do you mean the cut? Pretty much, yes. So let me kind of go here. So this is, I'm just going to use silver because gold and silver are very similar. So I've already got it open here. Let me just change this so we can see the candles. Just bear with me for a second. Here we go. So as we can see, gold and silver, again, I'm going to talk about them simultaneously on the silver chart because they're so similar. They've been moving pretty much sideways. I would expect this to continue, again, until we get that Fed decision, because, excuse me, how can we, or how can anyone really place speculative trades on a dollar asset when we've got a rate decision and forward guidance coming up in a few days? Well, they can't really, and this is why we're going to end up seeing these markets sideways until that decision comes. And then from there, again, I would expect the movement to come in and liquidity to flow back in. There is one other thing I wanted to mention, which is, I can't remember the stats exactly, so don't take these word for word, but again, it is within this range. So 1 week before Christmas, we can expect 50 to 70% of the normal liquidity we have in the market. So the markets will start to slow down. After that, we can expect about 20%, which is incredibly low, which again is why I stopped trading after this week. And then we will slowly start seeing liquidity come back into the markets until about the second week of January. Then we can start expecting the markets to get back to normal from sort of the 3rd to 4th week of January. It could happen a lot quicker than that. That's again just a general rule of thumb. So yeah, don't be the guy that sat on Christmas Eve trying to place trades and scalp, because it's not going to work. I closed my DCA short on Friday and went long on euro pound. Very nice, Phantom. Yes, I like it. I was short euro dollar, actually. I closed down, now pivoting to get into some long positions. Can we get the Edge Finder best setups? Yep. There they are for you. Can you put into one of your channels for cross-reference? Darwin, yes. So I always put the Edge Finder readings in the daily analysis. So if you go into analyst updates, click on the daily... the global cross asset daily intelligence, you'll always see them in those reports. Anyway, ladies and gentlemen, I am going to head off. Have a good one. Enjoy the rest of your weekends, and I'll speak to you all tomorrow. Last final note, live trading will be coming back in January. So every London session, I'll be back doing live trading with you like I used to. So guys, that's it. Have a good one. See you later.